Income taxes. In this discussion, we'll be discussing how to find taxable income. Then we will use the tax tables to calculate income tax. And we'll finalize this discussion with how to use the tax computation worksheets to calculate income tax. This is the third part of this chapter, chapter 20, dealing with taxes, income taxes. In this case, we'll be dealing primarily with income to individuals, not businesses. Okay. An income tax is a tax that is collected by your federal government. Many states and even cities will collect income taxes, and it will be based on the income earned by that person in that state or city, and of course in the United States. For the purposes of filling out your income tax return at the end of the taxable year, you will have to total up all of the sources of income that you received in the forms of money, goods, property, and even services that is not exempt from tax. The government considers all of these individual items as gross income to you. It increases your wealth, and therefore it is treated as income, and that income is taxable. The United States government considers the ability to earn income as a privilege, and therefore it is a taxable privilege. The Internal Revenue Service, it is the branch of the United States government that handles the processing of income taxes by the individuals and companies that earn income in the United States. When you are in the process of going through your income tax return, you will run into a situation where they will take your gross income, all of the sources of income that come to you, and then from that, they will subtract certain expenses and allowable deductions, such as individual retirement accounts, if you have student loan interest, maybe tuition and fees, alimony payment that you paid out, and so on. Each year, the tax laws change. So from year to year, what used to be may no longer be or may be altered in some way. So we are going to be talking in general, not with the specific up-to-date, last-minute changes in the tax code. It is very difficult to keep up with all of that. For the sake of this purpose, we will try to stay close to what the textbook here is speaking of, just so we get the general idea. The laws do change, but in general, the process of filling out your tax return is primarily the same from year to year, with the exception, of course, of whatever changes that have come into the tax law over the last year that you filed your tax return. So your adjusted gross income minus certain types of deductions that are claimable and provided by the government for you to do. And then once you take that adjusted gross income and subtract from it certain exemptions that you're giving for those people who are dependent, that you could claim as dependents. There are certain exemptions that you're allowed, and also a standard deduction, or in some cases, if you have enough deductible items that totals up to be more than the selected standard deduction, then you can choose that itemized deduction total in place of the standard deduction that is given to you. Once you take all of those things and deduct it from your adjusted gross income, you will end up with amount of money which is considered taxable. This is the number that you would use to calculate your income tax due based on your income earned. Okay. Okay, exemption or an allowance. Again, an exemption or an allowance is an amount of money that the taxpayer is allowed to subtract from the adjusted gross income for himself, herself, a spouse, and each dependent. A dependent then would be considered any person that you, the taxpayer, has provided more than 51 or more percent of their care, and they are not being claimed as an exemption of any other person. So to qualify for an exemption, you must be providing the primary support for that person. Okay, so for each one of those you get to add and you claim those as each allowance that you, exemption or allowance that you're given. There's each year, the United States government gives you a dollar value for that deduction, and you total those numbers up and subtract that from your income to arrive at your taxable income. So it's important. The more you have, of course, the better. But the government is realizing that each individual has a financial responsibility for those who he has to take care of, and therefore they give you these exemption or allowances from your income. They're not taxable. So as we can see here, exemptions are, of course, one way that you can provide some reduction of taxable income. The more exemptions you have, the less tax you pay. And so, of course, if you have someone that you can claim as an exemption, by all means, you should claim them, because it's going to overall reduce the amount of tax that you have to pay for the year. Now, in the year of 2010, the deduction for personal exemptions was $3,650 per person. And that's quite a long time ago, but the exemption hasn't changed by that much this in the current year. But you can look online to get the update numbers with what the current exemptions are. But for each exemption in the year 2010, you could have taken $3,650 per deduction and deduct that amount from your adjusted gross income in helping to reach your taxable income amount. Okay. Itemized deductions. Each year, the government creates its list of allowable deductions that taxpayers can use to deduct from their income taxes. Now, this is a dying breed, meaning this is being wiped away if it has not already been wiped away from the tax code, okay, in exchange for a standard deduction. But nonetheless, what it is there are certain deductions that can be used by taxpayers to reduce taxable income. The list used to be very long, and then it's got getting trimmed down. And as I said, it might be working its way out. So for the sake of what we're discussing now, just know that in the year 2010, there was a list of items that could have been used as an itemized deduction, that you itemize it, and if those totals exceeded the amount of the standard deduction, then you could choose to take that itemized list of itemized deductions in place of your standard deduction. So that's basically some of the discussion that we're seeing down in this chapter here. The standard deduction, it does change, but in the recent year, for most people, it was $11,400. Now remember, this is being very outdated, but you get the point. They are giving you an amount, and that amount you use to deduct from your adjusted gross income to arrive at your taxable income. So what we all have to do is every year we'll get a instruction booklet from the IRS government, and in that booklet it will give us what these numbers are, and we would use the current numbers for the year that you're filing your tax return. So once again, these numbers are numbers, but the concept is the same. Your standard deduction, of course, was the place where you would use to deduct your itemized deductions if your itemized deductions did not exceed the standard deduction. So the standard deduction is a specified reduction of taxable income. given by the government, and you just take that and reduce your income by that, which means by reducing your income, you end up with a taxable income lower than your adjusted gross income, which of course is to your benefit. But nonetheless, it is something that is provided because the government once again knows that the taxpayers should be given a break because you're earning income to make a living, or at least to provide the support for yourself as well as those who are dependent on you. And it's not just the luxury of earning income that you would use at your disposal, which meaning buying things that you don't need. So anything that's in excess of what they would consider as the standard amount that you need to live on, they call that taxable income. That's basically what it boils down to. Now, if you look at the numbers, you will see that, my goodness, the government is not giving you a whole lot of money to live on before they begin to tax you. So this is one thing you need to know. But in general, we already told you that taxes are a way that the government collects revenue in order to run part of the government. But you must sometimes do your own research, because it has been noted that the monies received from federal income tax, personal income tax, is primarily going towards paying down the national debt of the country, in which case no citizen sees no direct benefit from the income tax that they are paying, because the debt of our country is so high that we are doing everything we can and we're just paying the interest. But even with that, every year, the debt gets higher and higher. So your income tax, we get to see none of that. The government is using it to just pay the tax on the debt that we owe as a federal debt. And that's primarily being paid to the Federal Reserve. Okay, and that's information, that's the sideline information. It'd be difficult to dig and find that out because certain things the government does not easily disclose and they don't want the public to know. But if you do a little bit of digging and here and there, you'll find out from different sources that not all is as we are told. But that's just another discussion for another time. Let's get back to what we have talked about right now. Okay. The next part of this is filing status. I'm giving you the list of definitions and terms because this is all important to understand this whole ball of wax of what we need to worry about in determining our tax and taxable income. So your filing status is very important because according to your filing status, it is going to determine what category you're in, and each category, each status has its own tax rates. When we go to the tax tables, you will quickly see how, depending on what status that you file, you have a different tax to have to pay. Okay, so your filing statuses are either you're going to file as a single person, meaning you're not married, or you are married, filing jointly, meaning both you and your spouse are filing together one return. So you're joining all of your income and all of your information in one return and filing that together. Or you're married, but yet you choose to file separately. The husband files his own return separate from his wife, who files her own return separate from the husband. And then the fourth category is a category called head of household. The head of household is generally a single individual who does have dependents. You are paying for the support of someone, and therefore you have a category called head of household. That's different than single. A single person is just you, no children. You're on your own. No dependents, just yourself. Okay? So, finding your taxable income. Well, when you go to get a job at your company, they have a form called a W-2 form. And the W-2 form, your employer must provide that to you. And on that form, it is going to show you the total amount of income that you earned. It will also show you the total amount of income tax from the state, federal, and city levels that has been taken out of your income throughout the year. And they also will show any monies taken out of your income for Social Security taxes, as well as Medicare taxes. That one form is given to you with multiple carbon copies, that when you file your federal return, you must include one of those for each source of income that you receive, as well as when you file return for your state and even your city tax returns, you have a copy. Now, that copy that you have, your employer sends another copy directly to the IRS. So the IRS will already have a copy. So when you do your tax return, they get to match up all the different W-2 forms that they receive from all the different employers that you have, and that they'll use that to verify that the total gross income that you are reporting is correct. So make sure you understand that. That is what they're using that W-2 form. It is for you, for income purposes, and also is sent out to the government. Now, in some cases, you might not work directly as an employee, and you receive, instead of a W-2 form, a form called a 1099 from your bank. Let's say you have a bank account and you're earning income, interest income. So at the end of the year, your bank will send you a 1099 form. That 1099 form will, of course, show the total amount of income and interest that they paid out to you. So the bank will also send a copy of that 1099 to the IRS so that the IRS will have that as well. Their goal is to have a cross check of the total income that you're reporting versus the total income that they're receiving from all the different areas that are required by law to file these financial returns to the government. Okay? Now, your W-2 return by law should be sent to you no later than January the 31st of the next year. The income tax year goes from January 1st to December 31st. So your business, your company has 1 month to give you a copy of your W-2 form so that you can go ahead and begin filling out your financial tax returns. And your tax returns are due generally by the 15th of April. So you have several months to collect all your information and to fill out your returns and send them in. So how do we find taxable income? Whether you choose to itemize deductions or use the standard deduction, you got to determine what is your taxable income. We already told you what your taxable income is. All of your income minus all of those different deductions and allowances that you're allowed to deduct from that gross income to determine the amount that the government will call, this is the amount of money that we would use to calculate how much tax you must pay. That is the taxable income, the amount of income that you will be calculating tax on. Okay. So how do we go ahead and find it? We can find our taxable income simply by taking what you have calculated as your adjusted gross income. How do we find that? That will be your total income, all of the income you received, minus whatever allowable expenses and deductions that you have. Once you find your adjusted gross income, from that, you total up all the deductions or choose the standard deduction. So if you cannot itemize deductions, then you would choose the standard deduction, okay? And then we can find our taxable income by subtracting your itemized deductions or the standard deduction, one or the other, as well as the total of your exemptions. You subtract all of those from your adjusted gross income. The amount that's left will be your total taxable income. Now, this is based, of course, on all sources of income that you've received, okay? And you must report that. Let's look at an example and see how we can go about taking all this information and figuring out what is the taxable income. In this case, we're asked to find the taxable income for a family of 4, husband, wife, and 2 children, if their adjusted gross income is $67,754 and their itemized deductions are $11,345. They're going to use this $3,650 as the amount of each personal exemption. Now remember, again, this is for this example in this year of this publication. So the taxable income then would be the adjusted gross income of $67,754 minus the $11,345 for the itemized deduction minus the personal exemptions. In this case, they had 4. And the price for each, or the amount for each, is $3,650. So they multiply that by 4 and found out a total of $14,600 could be used for exemptions. Subtract that along with the itemized or standard deduction from the adjusted gross, and the amount of taxable income in this case is $41,809. This is the amount of money that they would use to calculate how much tax they should pay. Okay? I hope that made sense. So go ahead and look through your stop and check exercises 1, 2, 3, and 4. Please take time to go through this. I know there's a lot of information we discussed. Go through that. Make sure you can figure out how to arrive at the taxable income in each of these 4 examples. Check your answers at the back of the book before moving on. Now, moving on to the next section, we're going to pause this video because this video is getting kind of long. So we'll see you again at the next time, and we'll begin talking on the second part of this unit, and that is how to use the tax tables to calculate income tax. So we'll see you then.